We are back into earnings week. Now, before the market opened today, we saw PepsiCo report and they are down nearly 2%. Now, could this give us a great opportunity to buy this company? It is trading now towards its 52-week lows, and it does have a very attractive yield, which as it falls does go towards the 3.5% level, which is the highest it has offered over the last 5 years. Now, when we take a look at the reason for this, well, we can straight away see in some of the key points that they did miss Wall Street's estimates for their Q2 revenue, and one of the reasons for this, they do talk about the North American business unit reporting declining volume. Now, that is never a great sign. We're going to take a look at why that is, and we can see on top of that, they have given a more cautious outlook for their full year sales. One thing we will come on to though is that they did beat their EPS for the quarter. So in terms of the actual numbers, what we can clearly see in terms of the earnings per share, they did beat 2.28 adjusted. As we can see, Wall Street were expecting 2.16, so that is a nice 12-cent beat. However, on the revenue, even though they did miss, one thing that we will say here, it was fairly marginal, 22.5 billion. Expectation there was sitting at 22.57. Now, one of the reasons why when we look at this company, we do see that it has been hurt is essentially that they talk about how there is a struggle in the home market. A few things they put this down to: product recalls as well as shrinking demand for its products. Now, why is this? Well, they talk about how consumers in this day and age now are becoming a lot more value conscious, and rather than buying and paying for these increasing prices that Pepsi have done on their products to keep up in line with inflation, consumers are now either buying fewer bags of their chips, their beverages, etc., or they are still buying the same amount, but they are moving towards the cheaper private label options. Now, this has been seen, as we mentioned, in their volume, which has declined around 4%, and in terms of their beverages as a whole, volume down 3%. So not great at all if you are an investor. As we can see, whilst they did beat on the EPS, they did miss on the revenue, and there is a worry that this decline will continue, with consumers effectively looking at cheaper alternatives or just buying less items from this company. Now, one other thing that we have to point out in today's episode, as it did just come in not too long ago, inflation now falls down 0.1% in June, a great sign, and this is essentially the lowest level in more than 3 years, which is very bullish for those that are expecting rate cuts. A great sign for the economy that it is moving towards the right direction, if that is the thesis that you do believe with rate cuts as a whole. And we can clearly see the effect it has had on the S&P 500. The majority of companies are in the green. The ones that are in the down, in fact, Visa and MasterCard, which do look like some very good opportunities. Now, moving back to PepsiCo, let's take a look at this company in detail. Is it a great buying opportunity today, or should we wait until it comes down further? Dividend safety score, well, 93, very safe, always like to see that. And we can see their more recent increase to the dividend, 7.1% this year. We'd also say their dividend is very safe, reaffirmed in fact just a few months ago. Dividend cut does look to be highly unlikely. Key metrics, well, last recession, again, if you do believe consumers are becoming more essentially conscious with what they buy because their disposable income is decreasing, there is a possible recession on the horizon. Well, in the last recession, 07-09, PepsiCo in fact increased their dividend. They did have flat sales, but that was well above the average of the S&P at -12, and they also significantly outperformed the S&P, -5% return, when the S&P itself came in at -55. As always, one of the things we love about this company, nice increases to the dividend, 7.1 this year, 7% on average over the last 5 years, double digits over the last 20. It is truly a dividend growth company, and we can see they are a dividend king, 50 plus years of increasing those dividends. Now, one of the things we always look at on this channel as part of our deep dives, dividend yield theory. Now, this states a company is undervalued when the current yield sits above the 5-year average. Right now, we have a severe undervaluation signal, 3.37 versus 2.83. This is, if not one of the highest yields they've offered over the last 5 years, other than 1 or 2 days where it did spike to around 3.7% during the COVID pandemic drop. In terms of the forward P, well, it sits at 19.4, again, much lower than the 5-year rolling of 24, but as we can see, it is marginally higher than the consumer staples of 18.1. The thing we would say here is we're not looking at any of these models in isolation. We will conclude towards the end. One of the things that we do bang on about this company that we really don't like is the fact that their free cash flow payout is very high. Now, typically, I like to see below 60%, below 70% if you want to be specific for the industry, that is the trend. But we can see from 2018, it has been well above that, and a massive red flag in 2022. 111%, it means management paid out more in dividends than they generated in free cash flows. When you look at the earnings, you would not be aware of this at all over the last 10 years. One of the reasons why we do tend to ignore earnings data, it is susceptible to manipulation by management through accounting. 86% then on the free cash flow in 23. It is expected to come down lower in 2024. It is a good sign, but definitely one thing that I would say is a little bit of a drawback when considering this company. We then move on to free cash flow. As always, we want to see growth across the board, consistent as well. To be honest, pretty inconsistent. Yes, it has increased from 2014 to 2023, but year on year, there isn't that upward trend that we want to see. Nice to note that over the next 12 months, we are expecting a massive growth to this number, always a great sign. And sales growth, as we are going to come on to shortly in our analysis, we want to see 3 to 7% growth year on year. They pretty much achieved that from 2019 onwards, but again, they did go through a rough patch from 2014 to 2018. And again, those that do like to see that numerically, we can see across the board 67 billion in 2014, 92 in 2023. So you have to ask yourself, when you do include inflation, has it increased in real terms? That is probably just about the case over the longer term. Now, what they also do, return excess cash. They do those share buybacks, although fairly trivial. And in fact, over the last 5 to 6 years, it has been very minimal, if any, on a year-on-year basis. The one thing we do like, the ROIC, above 12% for consumer staples, give us faith management are able to effectively allocate their capital. We can clearly see the consistency, 19% over the last 3 years, very strong metric indeed. One thing we always like to see with a company, increase your revenue but also increase your margins. Not something we see with PepsiCo, so do bear that in mind. It is pretty much flat over the last 10 years, at least around the area that we like to see. In terms of the free cash flow margin, do be aware it has been decreasing, but still around that 7% that we want to see as a minimum. Finally, we move on to the net debt to EBITDA, a very important metric, correlates to dividend safety, balance sheet strength. Below 4 is what we want to see. Pretty much what we get consistently. Nice to note, over the next 12 months, this is anticipated to come down to 1.88. For those that don't know, these are essentially the number of years it would take the company to pay off all of their debt net of cash on hand. Now, before we continue with the analysis, just to let you know, we have released our latest free weekly article running through 18 undervalued dividend kings. All these articles are completely free. You can gain instant access by clicking on the pinned comment below. This article also comes with a free spreadsheet running through all the dividend kings, whether or not we believe they are undervalued and what our buy price and target price should be. Now, continuing with this company, just historically, we do note they are down 13% over the last 12 months. Over the last 10 years, as we will come on to show you, they have underperformed the S&P, up around 78%. Even if you do include dividends reinvested, it wouldn't be that much higher. And we do know their all-time highs sitting just under $200 about a year ago. In terms of the ratings, well, actually a hold from Seeking Alpha, a double buy from the other two analysts, and as we saw, the forward P&L sits just below 20, and that forward yield, as we saw on the updated number, is somewhere around the 3.4% level. So moving on then, in terms of the top line revenue and bottom line net income, we want to see growth. As we saw earlier when we did look at their revenues, it has increased from around 67 billion to 92 billion. And when we look at it graphically, we can see over the long term, it does move in the right direction. The key thing here is at least increase in line with inflation around the 3 to 4% year on year, something that maybe they could struggle with in the upcoming years as they are seeing declines in their volumes across their beverages and their snacks. Now, what is the story that we do see on the bottom line net income? Something pretty similar in terms of the growth, 6.5 billion to around 9.1 billion. So again, nice to see in terms of the trend, it is moving in the right direction, but similar with a few different metrics from PepsiCo, there is some inconsistency on a year-on-year basis. Now, in terms of the company's health, we always like to do a quick cash versus total debt analysis. 8.7 billion cash and short-term investments in 2014, 8.4 in their latest quarterly report, and we can see over long term very inconsistent, not much difference between the cash they had now and they had 10 years ago. And as always, that 8.4 billion cash, we need to compare it to a number, otherwise completely irrelevant on its own. And when we see it versus the total debt, 29 billion in 2014, $46 billion in their latest quarterly report. Something just to keep an eye on. It is a lot higher than their cash position, and we can see over the longer term it has been increasing. Again, something to consider, just because we also saw their free cash flow payout as well getting very, very high over the last few years. We then move on to their earnings, which I always like to look at. How have they performed historically? What are the expectations moving forwards? Well, look, over the last 4 quarters, they did beat on the EPS. Very good track record. In fact, their Q2 was what was released today, so they beat again as well. So actually, we can see over the last 5 quarters, they have beaten expectations. Very good track record. Over the next few quarters, then, they are expecting some nice growth, so that is always a great sign. And when we do look at the estimations, if you do have faith in them over the next few years, the forward P is expected to come down even lower. Again, it will depend on whether or not you do see this company continuing to be very strong on that EPS figure, and whether they can find a way to turn around essentially the issues they are seeing with the declining volume. We then move on to looking at some gradings. The first one, the valuation grade. Now, they get a D+. Remember, they are comparing it to the sector median. So effectively, whichever metric we look at, for example, the P where it sits at 20, we can see the sector median at 17, indicating this company is trading at a premium of around 18%. Whether or not you believe that is warranted, justified, again, that is what we are trying to uncover in today's episode. But the general theme, no matter which metric you do look at, we can see that it is trading at a premium. We then take a look at their growth grade. Now, they get a C for this. When we look at their revenue growth, well, around 4% year on year historically. Sector median, marginally lower at 2.5. Forward looking, 4.5. Again, sector median, marginally lower, but you could argue it is marginally lower, but it is trading at a much lower valuation. Again, a lot of things that you do need to consider. One of the things that we do like to look at, and unfortunately they aren't looking too great, is the earnings per share on a forward basis. 6.55% over the next 3 to 5 years, year on year. The sector median, which is trading at essentially a discount to PepsiCo, is marginally higher at 8.04%. Again, these things we will take a look at and factor in when we come to our margin of safety. Finally, well, profitability, great. An A+, that does look great. So gross profit margin, 54%, much better than the sector median. Bottom line as well, much better at 10% versus the sector median of 4.94. And then with the others, we get to see A's across the board. Cash from operations, a lot better as well, 12.8 billion versus the sector of 831. So a quick conclusion of this part of the analysis, a double buy rating with a hold from Seeking Alpha, a D+ on valuation, C on growth with an A+ on profitability. Now, are there issues with the industry? Is it just essentially something we find with PepsiCo? Well, in terms of others in the industry, we have Coca-Cola Company, Monster Beverage, Keurig, Dr. Pepper, and a few others. Pretty much all of these we have reviewed on the channel. Well, over the last year, now bear in mind, including dividends reinvested, PepsiCo the worst, or in fact one of the worst performing, right there along Monster Energy. What we can see though, those are the only two that have had negative performances, so it does look like there is something in isolation that the market doesn't like with this company. When we zoom out over the last 5 years, we do see them all in the positive. Pepsi around 38%, not the greatest return over the last 5 years. Over the last 10 years, we do see it somewhere in the middle, 138%. And for those that do like to see, it has outperformed Coca-Cola over the period. Now, it is important to understand that just because they have performed at 138%, it doesn't necessarily mean they will do as poorly or as strongly over the next 10. So always do ask yourself these questions before investing. And one of the main questions I like to ask when I'm looking at my own investments, is it going to outperform the S&P? No one knows the answer to that, but do you have that faith, that confidence that when you are executing on an individual stock over the S&P, that it will outperform? Historically, look, S&P is out over the last 5 years. Again, S&P has outperformed 88. Again, we can see that outperformance. Again, as I said earlier, past performance doesn't tell us anything about the future, just questions to ask yourselves. Now, we then move on to insider ownership, 0.14%, around 9 million worth of sales by the insiders over the last 12 months. But you would have to go to Q2 to see the latest. It was around 1 million, and then the next batch or tranche of sales of 8 million in Q4. Whether you believe this is outdated, not relevant, in fact, not a bearish signal, which I would agree on, they sell for personal or financial reasons. What we can, in fact, see was the latest sale was by the CEO, 5,620 shares on the 9th of May. As always though, do let us know your thoughts below. We then move on to the institutional ownership, just above 73%. We see 28 billion worth of sales by institutions over the last year, but a lot more buying, around 116 billion over exactly the same time period. But we do want to point out the majority of these buys came in Q2 2023, so pretty much a year ago. When we look at the more recent quarter, we actually see a lot more sell than buys, and the same to be said in quarter one. So do bear that in mind, that insiders have been selling in the more recent periods, as well as the institutions in Q2 and Q1. Having said that, as always, do your own due diligence. Never base your investment decisions off institutions or insiders. It is just one thing we like to look at as part of our wider, deeper dive. This then takes us to the valuation model. Now, our intrinsic value for PepsiCo does get to just over $189. The reason that we get to this number is we put it through a few models. The first one is the multiples valuation. We have companies in a similar sector and size, their average P multiplied by the EPS of PEP to give us our first undervaluation in the intrinsic value. But bear in mind, we don't look at any of these models in isolation. We then move on to the dividend discount model. Again, very nice growth over the period, coming in around 7.3%. We've gone a lot more conservative at 5.25. Again, another undervaluation signal. We then move on to the DCF model, where we have the free cash flow year on year. Average growth around 2%. Now, we have gone for around 11, roughly in line with analyst estimates and targets. It is also lower than the last year, which was very high. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and again, we have a third and final undervaluation signal, which is how we get to the intrinsic value of 189.22. Now, bear in mind, we don't stop our analysis there. We look at a margin of safety, and we start off with that 10% as always, and we execute on that if we believe it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, look, it is a buy around $170 based on those estimates and judgments we ran through. Then we keep going till it's near the current trading price, and today it is pretty much bang on a 15% MOS level. Now, with the earnings news that we did have today, with the declining volumes, with consumers moving away from their products or buying less and buying cheaper alternatives, you could warrant here around a 20% margin of safety. That means you would have to wait for around $152. Now, a lot of people will say 15% is sufficient. The yield is also a lot higher than what we have historically seen. The same to be said for the forward PE. As always though, do let us know your thoughts in the comments below. We can also see Wall Street still have nice upside over the next 12 months. Wall Street as well as Quant deem this to be a buy, with Seeking Alpha deeming this to be a hold. So in conclusion, a 15% MOS level, upside around 18%. But as always, let us know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.